All of Michael Burry's predictions are coming true one by one, much like Nostradamus, who was a French astrologer and reputed seer. Nostradamus is best known for his book, Les Prophéties, published in 1555, containing 942 poetic quatrains that allegedly predict future events. Many believe that a majority of his predictions have come true, including foreseeing a great war in Europe in 2022. Today, we have a living legend in the form of a Twitter user named Greek goddess Cassandra, which is actually Michael Burry's username. In Greek mythology, Cassandra was a Trojan priestess dedicated to the god Apollo, gifted with the ability to utter true prophecies, but cursed to never be believed. Similarly, Burry's bold predictions often face skepticism. However, there's no need to worry if you don't believe in Burry's predictions. Let's shift our focus to the main agenda: how to protect our investments and portfolios, even if Burry's prediction of a stock market crash comes true. In this video, we'll discuss what Burry is predicting and how to secure a decent return in turbulent markets. Michael Burry recently made a notable move by purchasing substantial put options against the Invesco QQQ ETF and the SPDR S&P 500 ETF Trust, totaling $1.62 billion. This accounts for 93% of Cyan Asset Management's disclosed assets. While the S&P 500 and NASDAQ 100 have been performing well in early 2023, Burry's past accurate predictions, such as the 2008 financial crisis, 2021 inflation, and the 2022-23 banking collapse, have piqued investor interest in his bearish stance. It's worth considering that this news reflects actions taken with a potential 45-day delay and may not represent Burry's current positions. The reported $1.6 billion investment is only part of the story. Burry's recent move involves purchasing put options on the S&P 500 ETF Trust and the NASDAQ Invesco QQQ Trust. The reported $1.6 billion notional value refers to the overall value of the underlying asset, not the actual cost of the options. Burry paid only a fraction of this amount. These options could serve purposes such as hedging or speculation, indicating that not all his bets are on a market crash. Z Management still holds stock positions, and it has increased stakes in companies like MGM Resorts, MGM, Expedia, XP, and CVS. This suggests the put options may be used as safeguards against existing long positions, rather than signaling a pessimistic outlook. However, based on historical data, it's worth considering that the stock market has experienced crashes in the past, such as in 1987, 2000, 2008, 2018, 2020, and 2022. The graph below illustrates how the market has plummeted from its peak. While this is speculative, it's essential to discuss how to protect our portfolios in the event of a market crash. One way to hedge against a market crash is by investing in top-tier companies in industries marked by sustained growth. This approach tends to be victorious in the long term. Additionally, maintaining a cash reserve can be a prudent strategy to navigate through market turbulence. Now, before we continue with this journey, if you're finding this video informative and engaging, kindly consider hitting that like and subscribe button. Every like fuels the algorithm and greatly aids our channel, and your support is genuinely appreciated. Without further ado, let's get back with the video. In the current economic climate, offering a risk-free 5% return is a prudent measure to withstand market volatility and seize opportunities as stock prices adjust. But there are additional strategies to navigate these uncertain times. Engaging in a covered call strategy is a solid approach to generate income and protect your investments, especially when you maintain positive sentiment towards a company, are not eager to sell your stocks, and believe a stock's performance has peaked. The trade desk, known as TTD, emerges as a standout choice for 2023. It has demonstrated impressive expansion and holds promising prospects in the realm of programmatic advertising, particularly in connected television, CTV. With the ongoing shift of advertising funds from traditional television to platforms like streaming, web, mobile displays, and online videos, the trajectory of programmatic advertising is strongly upward. TTD's stock has surged by 64% since the beginning of the year, showcasing its robust performance. The company has experienced remarkable revenue growth, soaring from $661 million to $1.6 billion in 2022, a remarkable 240% increase since 2019. This growth trend continues in 2023, with a 22% increase in sales during during the second quarter, even in a challenging advertising market. The trade desk effectively manages its finances, generating substantial free cash flow and employing share buybacks to offset dilution caused by stock-based compensation. Notably, the company maintains a debt-free status in terms of long-term obligations and holds over $1.4 billion in cash and investments, despite the premium valuation. With a price-to-sales PS ratio exceeding 21, the trade desk's performance stands out, even in the face of advertising deceleration and the potential for an impending recession. Prolonging the economic slowdown into 2024 is a strategy some investors are considering. It involves collecting dividends from recession-resistant companies. During market turbulence, investors tend to lean toward secure options like ABV, making it an attractive choice this year. ABV, with the ticker symbol ABBV, has raised concerns among analysts due to the loss of patent protection for its best-selling drug. However, the company's leadership has been proactive in preparing for this transition, evident through its acquisition of Allergan since 2019. Currently, the company boasts a diversified portfolio and 2 highly successful products to compensate for the loss of Humira's dominance. In 2022, Humira generated $21 billion in sales, and ABV has set a target of achieving a minimum of $17.5 billion in combined sales from Skyeye and Rinvoq by 2025. Additionally, ABV's activities in the fields of neuroscience, which involve Botox therapeutic and aesthetics, including Botox cosmetic and Juvederm, are yielding positive outcomes. It's important to note that every venture has its challenges, particularly in the field of oncology, where ABV has faced setbacks due to increased competition. Nevertheless, the pharmaceutical industry generally displays resilience against economic downturns. ABV possesses a substantial amount of free cash flow, totaling $25 billion over the trailing 12 months, which comfortably covers its dividend obligations amounting to $10 billion over the same period. The company has a history of consistent dividend growth, making it an established player in the market. Next up, share buybacks. Share buybacks are a crucial element of Alphabet's strategy, setting it apart as a robust player during market downturns. With an impressive $71 billion in free cash flow generated over the past year, Alphabet has initiated stock buybacks amounting to a substantial $60 billion. These buybacks equate to roughly 3.5% of the current market capitalization. If the stock were to experience a decline, Alphabet could acquire even more shares for the same investment, potentially amplifying gains for shareholders when the stock value rebounds. This strategic move could pave the way for a significant rebound in Google's stock price. Contrary to speculations about its decline, Google has actually witnessed growth in revenue, net income, and free cash flow this year. With an 85% market share, Google Search remains dominant, complemented by a host of advancements in artificial intelligence, AI. The rapid expansion of Google Cloud is reminiscent of a thriving plant, and the company's management is committed to enhancing efficiency. It's worth noting that while Michael Burry often holds a bearish view of the market, the attention given to his acquisition of put options might be overstated. However, considering the QQQ's year-to-date gains of 37%, there's a substantial price tag attached. This is especially apparent if we consider the potential of an impending recession, a perspective some share. To safeguard long-term investments and position themselves more resiliently, investors can employ strategies like holding cash, selling calls, and investing in industry frontrunners with consistent cash flow. These tangible measures can be undertaken without attempting to time the next market downturn. As we navigate these dynamic landscapes, remember to diversify, protect, and seize opportunities when they arise. Stay tuned to market trends and expert insights, but also trust your instincts. Thanks for watching. If you found this video valuable, please like, subscribe, and share your insights on the local stock market in the comments below. Your input is appreciated. Until then, happy investing.